Thank you for joining me. I'm Alexandra, and I want to talk about Nordstrom. So, Nordstrom does retail, mostly apparel, and I used to own the stock, and I actually bought some more during the pandemic when, interestingly, the price was lower than it is today. Um, but obviously, they paid a dividend back then, which was kind of the selling point for me. They don't do that now. Current price is $45.79, which gives them a market cap of $7.2 billion. Revenue $10.7 billion, which is down 30%, which is not great, but there was a whole pandemic going on. Earnings of negative $690 million, which is actually not that bad considering what happened. So, revenue down $5 billion and earnings only down a billion or so. It's not terrible. PE of negative 10, obviously a problem. Forward PE of 23 would be nice if they could hit that. Obviously, with the stock price rising 10% in a day, the PE is not entirely accurate, even if they hit their goals. Dividend is zero. I do expect that to change, but I don't expect that to change this year. I probably don't expect that to change next year, but if they could get back to normal, I would expect them to pay out a dividend in 2023-ish. That's kind of the MO of the big retailers. Total assets $9.5 billion, total liabilities $9.2 billion, which gives them a stockholders' equity of $305 million. And interestingly enough, they didn't do stock buybacks last year, which I strongly approve. But the balance sheet had always been terrible. So they did stock buybacks, and they did cause their own balance sheet to be this bad. But I mean, it could be worse. It could definitely be worse. So, stockholders' equity of about $1 billion with a market cap of $7 billion is not terrible necessarily, but I would like the assets to liabilities ratio to get a lot better. I don't think it's going to happen though. Risk factors. Global pandemics would be number one at this point, I think. Overall, obviously, they have competition from Amazon and other online retailers, and I don't expect that to decrease in the future. So, there's obviously still a risk there, and the whole malls dying thing is also a problem. But overall, I don't think anything is going to fundamentally change from this point on. It's just that the competition that's already there is probably increasing. So, for a growth investor, obviously there's nothing here. The 15 billion revenue was very consistent for the previous 4 years. 10 billion now, not great, obviously, but can't really judge the company based on what happened last year because it was pretty terrible. For a dividend investor, I would probably wait until they decide to pay a dividend again. I don't think there's any harm in waiting here. After that, I would check the balance sheet because I probably wouldn't invest in a company with a balance sheet this terrible as a dividend investor because the safety of principal is probably the number one factor. For a value investor, the balance sheet is pretty terrible. The forward PE is okay. It's not great. And again, the stability of the company is kind of a problem. So overall, I don't think anyone should invest in this right now. But that doesn't mean that no one should invest in this in the future. I think that they will get back to more or less usual and they will start making profit again. And at that point, I think it's time to reevaluate and see what happened and see what the plan is going into the future. That's it for me for today. If you like this video, make sure to subscribe. I'm coming out more videos every day before market open. I hope you have a successful day.